Why did I wait? If there's one phrase I've heard more than any other in my career, it would be this. And not just for the times we think we missed investing at the bottom, but because there's an inherent understanding that the most valuable thing we have is time. And guess what? No one can give you any back. But lately I've been hearing this lament more and more from retirees when it comes to Roth conversions. Why did I wait? So in this video, we're going to discuss some of the impacts waiting to convert can have, and take a look at a quick example of how a person might cost themselves thousands or even hundreds of thousands of dollars in taxes over their lifetime. And stick around to the end on this one. Some of these numbers are pretty eye-opening, and spoiler, it gets even worse when we consider what's left to the kids. But first, I'm Curtis Crossland of Suttle Crossland Wealth Advisors, and the purpose of this channel is to discuss financial topics and ultimately help people build more tax-efficient retirements. So let's get into it. Now, the first thing to mention is that Roth conversions are not a given for every single situation. Careful consideration and planning needs to be conducted by everyone to understand if there's a potential benefit for them. So you might be asking yourself, so who does benefit? Well, that's going to be folks that have significant pre-tax assets that will eventually have to do required minimum distributions, and also someone that has a series of years to take advantage of low income situations. Not always, but often this is going to be folks that are early in retirement. They typically have several years to go before things like required minimum distributions and Social Security kick in, but who also don't have pensions or high regular income from other sources. So think low income with time to be able to convert. So how can someone cost themselves more in taxes by waiting too long? Well, once you hit certain milestones, the ability to avoid or control how much income you recognize becomes extremely difficult. While the IRS does allow for folks past 70 and a half to do things like qualified charitable distributions, a combination of income from sources like Social Security, required minimum distributions, other investment income, pensions, or rents, they can create a scenario where your yearly income is very high, pushing into higher and higher tax brackets, and perhaps even causing you to experience higher surtaxes, like higher Medicare premiums or even net investment income tax. This also has the potential of pushing you out of certain credits that you may be going for. And this can become an even bigger problem if one spouse were to die early on in retirement and the survivor is then dealing with lower tax brackets as a single person. I've done other videos on some of those issues. You can check those ones out next if you'd like. Now, you may also end up in a situation where you have a lot of IRA or 401k money that just continues to grow through retirement. You might even have really large required minimum distributions, and those may continue to get even bigger each year that goes by. Here you can see in the IRS's publication that your life expectancy factor each year changes. This can result in a bigger RMD calculation, especially if your portfolio stays the same or continues to grow. And this can be a pretty involved topic itself, so let me know in the comments if this is something that you'd like a more technical video on, or if you have other questions related to this that you'd like to see in a video. Converting during early retirement or opportune years does mean you'll pay taxes sooner, but paying tax on that money sooner may mean you're paying lower taxes in the long run, and avoid things like tax torpedoes and other tax traps later when your options are very limited. Let's take a look at an example of what I'm talking about with some real numbers. So here we are in our example. We're going to be using my favorite volunteers, Joe and Jane, and we're going to take a look at what delaying or waiting too long to do conversions might look like for somebody that possibly had a benefit. So here we're saying Joe and Jane are currently 60 years old. They are retired. And the question is less about do they have a successful retirement and more about the difference between convert or not convert. Did they decide to do it? Did they do it when they should? Or did they wait too long and did the opportunity pass them by? And then what is the ramification, if any? So let's get an idea of what their situation looks like. Here, this time, we're going to say they have a total net worth of $2.8 million. And what that's going to be made up of between them is $150,000 in a bank account. They have a home value of $600,000. But then importantly, if you take a look, the 401k value for Joe is $1.3 million. And then the 401k value for Jane is $750,000. And so between the two of them, they have just a little bit over $2 million in 401k or pre-tax money. This could also be an IRA, a SEP, really just anything that's going to be pre-tax. If we come up here and we take a look at their goals, pretty straightforward stuff. Retired now, they're going to spend $8,000 per month in retirement. We have a little bit of added cost just for some extra healthcare concerns. And then we just tossed in a little bit of a lifestyle or vacation budget. It's $20,000. That's basically basically going to run them over the next 10 years or the first 10 years of their retirement. And so we'll take just a really quick look at their income situation. We're going to say that they have Social Security, and then they're really just going to have to live off of whatever else their portfolio will produce for them. So now let's hop over, and I want to take a quick look at the retirement situation. So here we can see a very strong Monte Carlo, probability of success 99%. We can also see a high terminal median balance on accounts as it projects over their lifetime to age 90. So right now is the part that we care about. We're trying to understand, okay, what is the difference from them now at age 60 if they just don't even really think about conversion, or maybe they don't learn about it till too late, versus what if they heard about it? What if they see a video somewhere and they decide, hey, this is something that we should explore and start to do conversions now? What does that difference potentially look like? And what are the ramifications either way? So what we'll do is we'll say, hey, they don't really hear about this till they're 80. They do know conversions up until that point. Well, what can that look like in their situation? Well, here we'll actually come over and let's take a look at the cash flow for them at age 80. And we can see it here. And looking across, we can see pretty high planned distributions. We can see high total income. Yes, they'll have a lot of expense, but now we can start to see an escalation in their tax payments. And as you can see, this actually gets higher as you go down and as they get older. But at age 80, if we take a look into their planned distributions, what is that? Well, it's the required minimum distributions. So let's say at age 80, all of a sudden they're starting to see these high tax bills and they're wondering what is going on. They get curious, they start to look around and they hear about conversions. Okay, conversions. Well, at this stage of the game, they might do like a lot of folks do at 80 and say, well, there's just not a lot we can do. And part of that is because if you do Roth conversions, that has to be on top of whatever your required minimum distribution is. You can't use it in lieu of a required minimum distribution. So if they're already recognizing $200,000 of income from these required minimum distributions, they may not be keen on making large conversions on top of that as they're likely already in higher tax brackets. And some might say, well, that, they have qualified charitable distributions. Maybe they can use some of those. And in some sense, yes, but you have to give that money to a qualified charity as part of that qualified charitable distribution, but you're still going to have to convert then on top of that. So unless you're already charitably inclined in giving large sums away, not everybody is going to want to have to give away a lot of their IRA account just to then be able to convert. So again, at this point, they might feel like, you know what, we're just going to sit tight. We waited too long. Maybe we regret it, maybe not. So at this point, they might just say, look, we're just going to sit tight. We didn't do this soon enough or consider it soon enough. We're at a point where it's just not as feasible. But even when we jump over here and we take a look at their situation of waiting too long, waiting till 80 to think about or consider conversion, they still have a very healthy ending portfolio value, and this is still something that's going to have them in a position where they're able to leave a lot of money to heirs and have lived a nice retirement without having that fear of running out. But that's not the end of this video. It can't be. We need to see what is the difference. We need to know what happens if they go the other route. But let's come back to now, and let's say that they heard about some ideas on conversions and wanted to explore it for themselves. What might happen? So there's a nice little tool that allows us to try to see what happens if they were to do any sort of conversion strategy in their situation. Is there kind of an optimal path or not? And when we actually run this, we can see that there may be an opportunity to do conversions up to that 22/25% income tax bracket. And so let's go explore that and see the difference. So if we come over here, and if we say that we're going to do conversion up to that 22/25% income tax bracket, what happens? This appears to have some substance. So right off the bat, we can see that they would have more projected tax adjusted ending assets. And we'll actually come back and look at that because that's where the numbers get even crazier. We can see that they have a projection of less taxes paid of just over $500,000. And that's significant. Had we looked at a conversion situation where by converting, it would have saved them, $5,000, $500, even $50,000, you start to get to a point, if that's the case, where you wonder if the juice is worth the squeeze. But at least here, even though this is not a crystal ball and take everything you're seeing with a grain of salt, this shows that there could be a material benefit. Doing conversions from this age now, not waiting and not then having that regret later shows that there is a real potential for some significant savings on the tax side, but also an improvement in the tax adjusted ending asset. And just to be sure, we're going to come back here and actually take a look. Let's see what happens if we try to bake in that tax idea into their Monte Carlo. And when we do that, we see a very slight dip from 99 down to 98%. We see a little bit of a dip as well in that median terminal balance. But to me, this is not significant enough to say, well, I shouldn't consider it from the sake of whatever the Monte Carlo or probability distribution is showing in terms of that success. But there's a couple other angles to this, because a lot of times when you're looking at things like, well, should I convert? That may have ripple effects into other areas of your planning. So one thing that I see a lot, and especially in something like planning software here, especially like in Right Capital, something that can actually change is going to be when and how you recognize additional income. So something like when you take Social Security can also have a benefit. So if we say, well, hey, let's do the tax strategy. It's 60, in terms of the conversion. What happens if we say that we're going to take Social Security at 70 or the optimal strategy according to the software? We actually see an improvement in the terminal median balance. The Monte Carlo still shows a 98%, but by changing and delaying Social Security till 70, we actually have improved the projection on our median balance at death. And so another wrinkle to this is if we come back and actually take a look again at that tax strategy, and we cross this over now to that proposed plan where we're saying, let's delay that Social Security, it actually improved these numbers even further. So when I hear somebody ask the question, did I wait too long? Or maybe they even have a realization of, that regret, I waited too long. There could be some validity to that. And so now we can start to see what some of the ramifications are if you don't take the time to try to understand this for yourself, especially if you're at an age to do this. And yes, there are going to be people that will likely find themselves to be stuck. That doesn't mean that their situation is on a crash course, as we saw in the situation where they didn't do any conversion and we looked at that terminal balance, it was just fine. But if you're like me, you're not fine with just fine. You want to try to optimize. And outside of having the right allocation for your portfolio, doing all of the right things in terms of your investment management, what you're doing with your cost efficiency and what you're doing with your tax efficiency is a big deal. Those are effects that I've said multiple times in prior videos also have compounding effects. And so that means the more time that your portfolio exists out into the future, rest of your lifetime, past your lifetime, your heirs, their heirs, those inefficiencies are going to compound as well. And so let's take a look at the comparison here on the tax adjusted ending portfolio balance and talk about some of the difference. So in the conversion approach, Joe and Jane are able to get 100% of their portfolio converted during their lifetime in the example. And the difference here on the right is that they're not able to do that if there is no conversion, but we still see very positive ending portfolio balance numbers here. The one that we see on the left is a far more attractive number, and it's because of the effect that taxes can have in a situation where there is no conversion for Joe and Jane. But it does not end there, because the last thing that I want to highlight is what happens over the course of the following 10 years, those 10 years after they pass. Now, my last video looked specifically at this point and went into it in more detail. So if you're curious on this particular topic, those 10 years after you die, check that video out next. So this portfolio on the left here, if you're able to convert everything to a Roth IRA, and if you can leave that to your beneficiaries, they're going to be in a position to benefit greatly from this. Current tax law is that you have until the end of the 10th year following the year of death for your beneficiaries to distribute the account balance. So in a Roth IRA, there are no required minimums. Your beneficiaries could basically leave the money in the account all the way up until the end of that 10th year and let it continue to grow. Then when they take those dollars out of the account and distribute the account, the idea is they would get all of that tax-free. So imagine leaving $6.8+ million, it getting to grow for an additional 10 years inside of an inherited Roth IRA. And then at the end of that 10 years, they get to distribute it and they do not have to pay any tax on that distribution. The portfolio on the right, however, is not going to have that same experience. And that's because if you do no conversion, if you don't use the whole portfolio during your lifetime, what you leave to your beneficiaries, they have 10 years to distribute. But there are different rules on getting pre-tax money in an inheritance. They may be required to do stretch provision distributions on top of having to take out all of the money by the end of year 10. What if they're still working? What if they're in high income brackets, earning the most they'll ever earn in their lifetime? Well, as you might imagine, this is going to create a bit of a challenge in terms of, well, do they take all of it at once? Do they break it up over the course of years? Do they wait till the end? But then in addition to that, there's going to continue to be tax on those dollars until they're fully distributed from the account. So let's take this a step further though. Let's just, for the sake of this video example, keep the numbers the exact same. Let's say Joe and Jane could leave $6.8+ million to their heirs tax-free in the Roth, and let's say they could leave the same $6.8 million to their beneficiaries, but in a pre-tax. Now, I know the percentages show a little different here, but stay with me just for the sake of the example. If over 10 years, the portfolio that they leave was able to average 7% annually, the $6.8+ million could potentially grow to $13.5 million. So essentially doubling the balance of the account. If that money's in the inherited Roth, the idea is all of that comes out tax-free. However, let's assume just something real simple. We'll say a 15% effective tax rate on those dollars. So if instead it's left in a pre-tax account, and no matter the machinations over that 10 years, let's say there's an effective tax rate on those dollars of 15%, we're looking at a balance amount instead of 11.4+ million. We'll call it 11.5. So that's nearly $2 million additionally that could be lost to taxes after Joe and Jane are dead after the 10 years. But like I said, the situation with leaving pre-tax money can be a bit more complicated, having to take money out year by year potentially, or having to do it just for the sake of, not having a blowout in terms of income and rocketing all those dollars into really high marginal rates. So after looking at all of this, would it be fair to say that if Joe and Jane waited till 80 to look and say, hey, should we have done Roth conversion? What does our situation show us? I think in their situation, we could say yes. They would likely have pretty tremendous regret from not exploring this in years where it makes sense. But I certainly love to know what your take is on this. Let me know in the comments if any of these numbers surprised you, or let me know if there's another aspect of this we need to dive into deeper. I'd also love to know what you're planning to do with your own retirement and conversion situation, so let me know down in the comments on that as well. And if you watched this video and thought that this is something that you need to do for yourself, be sure to check out our links. And if you got anything out of this video, I'd sure appreciate a subscribe. Who knows, maybe I'll make a video discussing your concerns next. Once more, I'm Curtis Crossland, and if you want to see how we help folks build a more tax-focused and efficient retirement, be sure to check us out at SuttleCrossland.com and subscribe for future videos.